Mr. Anuj Mathur, Managing Director and CEO at, and in fact Tarun Rustagi, who is the Chief Financial Officer at Canara HSBC Life Insurance. Welcome both of you, gentlemen. Let me start with you, Mr. Mathur. Growth has been extremely strong for you. What's driving that growth outside of GST, of course, which was likely one of the factors aiding the growth numbers? What is it that you're doing differently?
Fine. Good morning to all the viewers and thanks for having me on the show.
Wishing you a very good
Yeah, that's right. We had very good set of numbers. And you see the business model which we have, which is banker driven, is actually globally, if you see, is also very, very kind of profitable as well as growing business model. Even if you look at India in the last many years, banker has done well. So we have that competitive edge in terms of our bank partners, in terms of our business. And you will see that our performance, our growth is going to be superior compared to the industry. So industry is also doing well, let me admit that. But in our case, because of the superior business model which we have and great support coming in from all our distribution partners, we have posted these results.
If I can come to you, Mr. Rustagi, how much of the growth is what is leading to the margin expansion, and how much of that margin expansion is actually sustainable? Give us a sense of that.
Good morning to the viewers. So in our case, what we have seen, and that was our strategy also to focus and improve protection business proportion of the total business. So the growth in terms of top line is coming for this quarter. It has come due to the continued demand of unit-linked business. But however, along with the unit-linked business, we are able to improve the margin because we were able to attach riders and also increase the protection proportion, both on the individual side and also on the credit life side. So as a company, we are focusing on increasing the protection proportion in our overall mix and also keeping a balanced product mix. So we expect that the growth will continue in these two business segment or a product segment. And another segment which is also working well for us basis the detailed analysis which we have done in terms of our customer segmentation is the annuity business segment, which is also growing very well for us and also contributing to the profit for the organization.
Mr. Rustagi, let me extend that. Your contribution of ULIPs is likely to continue to shrink going forward. How much of a contribution will that make to your margins? And therefore, give us the aspirational margin number that you're seeking to look for and the aspirational product mix you're seeking to look for. Because currently, ULIPs is a larger chunk of your product mix.
So unit-linked contribution is going to shift towards more traditional. And as we know that traditional businesses in terms of VNB margin contribution is contributing more than unit-linked. So we expect that shift is going to contribute more towards improvement in the VNB margin over next 3 months also and next year also as per our strategy. We don't believe in pushing any particular product segment. So it is basis the market demand and the customer demand. So we expect that it will balance it out over a short to medium term period. And in terms of our margin guidance, it is like we mentioned, and we are going to maintain the similar one. We are going to improve, what margin we reported last year, for FY25. And you will continue to see the improvement. So this year, for this quarter, 9 months, we actually basically reported our VNB margin of 19.7%. And we expect that this continuous growth will be visible in our next quarter results also and in near future also.
Okay, Mr. Mathur, let me come to you. So that margin number of near 20% is what you've clocked. You were anticipating an impact of around 220 bips as a result of GST. Now you are penciling in an impact of only 185 bips. That should further aid margins going forward, or is this already built into your margin?
See, to some extent, it's visible in the margins which we have reported.
Okay.
And see, it's a continuous process. So, 225 basis points or 2.25%, which we estimated about 3 months back, has changed. And obviously, with various steps which we are taking, as we are kind of getting into this in terms of OPEX reduction, in terms of various efficiency measures, it is quite possible. I can't project a specific number right now, but quite possible, basis the initiatives which we have taken, that we may see a lesser dent compared to what we had originally estimated. But I can't project exact number. That is something which people will see over a period of time.
Okay. How quickly does it go up, Mr. Mathur, at least in the near term? Because, and sorry I'm persisting with this, but I'm trying to get a sense that you've seen a reasonable uptick. I'm trying to understand, can you be 20% plus exit FY26, or would that only come in at the end of H1 FY27?
See, I'll not like to comment on any specific number,
Sure.
but I'd like to mention about certain initiatives which we have taken which are helping. Like even in case of unit-linked business, as Tarun was explaining, that there's good customer demand. What we have done, we have attached riders, protection riders, which is helping us in terms of optimizing our margins. We have actually expanded our credit life business, which is actually helping us in terms of optimizing our margins. Our volumes have gone up. Our costs are kind of contained. So all these measures are actually helping us. And what we should see is actually more efficiency, better margins in times to come. But it's very difficult to project a number or kind of give an exact number right now.
And and the APE, Mr. Mathur, the APE growth that you've witnessed of 37%, are you seeing, are you continuing to see traction with regard to growth? And is this 25% plus kind of growth number something on a very, very low base that you, or rather not very, very low, but on the low base that you have, can you expect to continue to see that kind of traction?
See, I would suggest that we look at slightly longer term picture. And if you see our 9 months, our AP growth is about 22%. So I think quarter on quarter, it's fine to see, but I think we cannot derive any particular guidance from that. Certain quarters will be good, certain quarters may not be that good. But as long as overall, on a yearly basis, we are able to kind of beat the industry number, I think then we are doing a good job. And that's our aspiration, that we will continue to deliver AP growth, which is higher than the industry.
And Mr. Mathur, hi, morning. Good to be speaking with you. Talk to us about your product mix. You're expecting the ULIP mix to decrease, but the traditional mix to go up. Talk to us about where the product mix is headed. What could be the direction there?
So, see, we are looking at optimizing our traditional mix, but see, we don't force any particular product on the customer. We go with customer need, customer demand. So we see over a period of time, and if I look at our customer profile, with Canara Bank being there and our presence through tier 3, tier 4 cities as well, we expect that our customers, the demand for traditional products, guaranteed products, likely to go up. So it's basically basis the customer profile, what we anticipate. So our UL mix is going to reduce, but I don't think so it will significantly reduce. I think as long as we can optimize our margins basis, that should be okay. We expect that our unit-linked business could be in the range of about 50 to 55% as we close the year.
Mr. Rustagi, how is your distribution mix playing out? Give us a sense of that. Canara Bank, of course, will be one of the levers that you lean on. But what about your other distribution levers?
So, like we mentioned earlier also that, bank assurance is our core and will continue to focus and grow bank assurance channel. And Canara and HSBC both are contributing along with the, significant growth in RRBs. So overall, bank assurance, including RRBs, contributed 90 plus percentage of our total business, which is similar to earlier trend also. And 10% is contributed by other channels. So this quarter, we actually launched agency channel. And we expect that in medium to long term, this proportion coming from agency will increase, and therefore non-banker proportion will improve from 10% to high teens kind of a number. So that's something which we are targeting. And within the non-banker channel, like you rightly mentioned, Canara contributed significantly out of this 90 or almost 75% of the business volume coming from Canara. And that is our growth engine, actually. And in non-banker, it is almost 50% is contributed by digital channels and 50% by other, distribution channel. Like our direct sales force, and we have good presence on the defense side also. So this is the overall product mix which we registered for 9 months.
Okay, so good to be having you on board and getting a conversation with you, Mr. Mathur and Mr. Rustagi. Thank you so much for your time.
Thanks.
Thank
Thank
you.
you very much.
Okay, on that note, viewers, time to slip into